All right, so this will be the first modules homework assignments. It'll be chapters 1 and 2. I'm just going to briefly go over the questions and the answers here. You see here in the first question, this is talking about financial assets and real assets. The way to think about this is like real assets are things that you can put your hands on. So we'll talk about the financial economy and the real economy, where the financial economy is Wall Street and the real economy are like the Toyota plant, physically doing things. So same thing, we have real assets, and then we have financial assets that we create or destroy as needed for our economic purposes. Same type of question here. Just trying to get you to understand the difference, in real assets and financial assets. So obviously these people are less wealthy, but the houses are still there, right? So the real economy and the financial economy don't move together always. Again, the same type of thing. That what you're trying to understand is this difference between real and financial assets, and also the difference between liabilities and assets, because financially speaking, a loan would be a liability for me if I took out a loan, but it's an asset for the bank, right? Because they can turn around and sell that or use that as collateral. So we can create financial liabilities and assets concurrently. In fact, we have to for the balance sheets to balance. But that's what this is getting at. Okay. So this is a scenario where a woman has a company. She has some cash. Part of that's from a loan, part of that's shareholder equity. And then you see the situation as different steps go forward, and you see that's what A, B, and C are. And then if you see this ratio of real to total assets changes, because cash, while you may think of cash as being real, just remember that's a claim on something financial. The cash itself doesn't have value. So we would treat currency the same way we would treat ones and zeros on a debit card. That's all a financial asset. So yeah, the shares of stock, while also that would technically be a physical thing, it represents this financial idea. So that's also a financial asset. Okay, there's a lot here, but just to understand, this was a table that they asked you to pull up in the problem, right? So when you look at this, what is this ratio? Just understand that, if you think about it, commercial banks are going to hold a lot more financial assets than real assets compared to, say, a manufacturing firm that's got equipment and work in process and inventory and all of those things. All right. And so that was chapter 1. Chapter 2, we get into a bit more math here. This first problem, just understanding that municipal bonds are going to be exempt from those taxes. So you can effectively have a higher yield. So even though it's only 7.25%, when you think of your after-tax return, it's actually 12.08%. Same thing here. Municipal bonds offer a tax shield. And so what would be the equivalent yield? You see the math below there. And then the same type of question here. We have different tax rates. And then what is the yield that would be equivalent to 3.9%? All right. And then this one right here. So if you notice, there's a price at time 0, time 1, and time 2. And then there's a quantity at type 0, time 1, and time 2. And so calculate the rate of return. What is the divisor? And then calculate the rate of return for a price-weighted index for the second period. So we have two different ones. So this is the question. I'm going to go to the next slide to show you the solution. So if you see at time 0 and time 1, we're using just the average of those stocks right there, time 0 and time 1, to see that rate of change. And so in B, we have to account for the split, right? And because of that split, we change our divisor. So instead of being divided by 3, it's actually only going to be divided by 2.33, right? Because of that split, right? So, and that divisor changes. That's when you look at like the New York Stock Exchange, it's one of these valuated. So it has that divisor change, and they actually publish what the current divisor is. Okay, and then here's question 2.5. So instead of what a slightly different way of calculating it, obviously, and you see the equation there on the side. So instead of just equally weighting them across the 3, we take into account the quantity, right? So that's why it's market value weighted. So that return is going to look a little different. I'm going to go back. Right, and see how those numbers are different on those weights of return. So, and then here on problem 6, we have a T-bill, and we're going to compare it to a regular bond. The tricky part here, T-bills, we always quote 12 months a year, 30 days a month, and that gives us 360 days a year. And I know that's not actually how our calendar works, but that's the convention that we use for U.S. Treasury. So they're kind of weird in that way. Everything else we use 365 days. And just so you know, we actually use that also for leap year. So even though that particular year would have 366 days, the convention we use is still going to be 365. It's just to make our math consistent. Although I say make it consistent, I showed you 2 different examples for 2 different bonds. So all right. And so here's another one just to let you start to understand how some of these relationships work. So we look at a higher coupon versus a lower coupon. Higher coupons are better, right? Something that's got a lower exercise price on a call has more value than something that's got a higher exercise because you're going to be able to exercise it sooner as a call. And if it's put, let's see, a put is selling at 54 or a put at 64, the put at 54 would be more valuable. Okay. This one here, you notice I've also dropped in that table figure 2.11. These are what's known as futures, right? So what you're doing is you're locking in your price today for what you're going to pay for delivery in the future. This is something that we set up in the United States back in the 1800s. In fact, you see that Chicago Mercantile Exchange. Why Chicago? Because that's where all the farmers from the Midwest would bring their produce, their grain, their cattle. All that came to Chicago because that's where the rail junctions were. So we got this commodities exchange, and you can buy corn. And if you see there for delivery in September of 2019, December 2019, May of 2020, December 2020, July of 2021. So this is they have these out there. So if you're buying corn, you can go and lock in your price. And so that's what you're seeing here, for how we would calculate the price of it. All right. And this problem is a little bit longer. So I broke this into 3 different parts. So you see right there the stock options on the table, 2.10. And so if the stock expires at 139, would you exercise? And you see there, yes, we would, because we have it at 135. It expires at 139. That's $4, right? So per share, right? And then we calculate our net profit and loss because we got to pay for that option, right? And then what is the rate of return? We actually still end up with a loss. So even though we made money on the option, we lost money because we didn't make up the purchase price of the option. And so there's still a bit of a net loss, even though the stock went up from 135 to 139. Okay, here's part B, right? What if it was a different call, the September call with an exercise price of 130? That one's better, right? We make even more money from 130 to 139. The $9 difference is more than the $8.65 we paid. So we have a net profit instead of a net loss, and we do get a positive rate of return. And then here, if it is out of the money, right? So if the price is at or above the current price, if it's actually at the exact same price, we would say it's at the money. But if it doesn't go above that, then it's out of the money, and then that expires worthless. And if you notice, the rate of return is a negative 100%, right? It's 100% loss because you lose all your money, right? You can't lose more than that, but you do lose all of your money. Okay, and then problem 10, both a call and a put are being traded. They both have this strike price, and they both expire at the same time. This may sound kind of strange right now, like, wait, why are we buying two things the exact same price, one call, one put? When we look a little bit later at doing things like what we call spreads and butterflies and things like that, we use these types of contracts for more complicated payoffs. So that's what this is for. And then you can just see there, as the stock price goes below 48, right? You start seeing those initially, there's a negative there. It's a loss, right? And then once it goes above 48, it's a profit. That's why we would say it's out of the money and then in the money. But if you used to watch old Bugs Bunny cartoons and you heard them singing "We're in the Money," that's where that actually comes from. And the same thing for B, only this one, instead of being a call, which gives you the right to purchase, a put gives you the right to force someone else to purchase. You have the right to sell. And so the lower the price it currently is, the better, because you're locking in that you're going to sell it at a higher price. And so as you see here, the profit and loss again going down. So let's see. And I believe this may be our last one. So we're looking at this after-tax return. We have the cost of the stock, right? And then we have the dividend of the stock. And so we have the change in price, we have the change in the income from the dividend, and then we have to say what is our total taxable return. Then we pay our taxes, subtract the taxes off of that return, right? That $4 dividend, right? And then we're able to use that to determine what is our rate of return off the $46 investment. In this case, it's 7.78%. All right, and that's it for module 1. We're hoping to get started really good on this. If you have any questions or concerns, please do not hesitate to give me a call or give me an email or speak to me in class, and we will get it all fixed for you. Thank you.